remember, things are never clear until it's too late. Welcome to the Financial Library, where I simplify the biggest lessons from the best financial books ever written. Today we're talking about the book One Up on Wall Street, written in 1989 by Peter Lynch together with John Rothschild. It's a friendly and practical guide for everyday investors who want to take control of their financial future. Lynch, one of the most successful mutual fund managers, shares his belief that average people can outperform professional investors simply by leveraging what they already know. The book is filled with relatable stories and easy-to-understand advice on spotting winning stocks in your everyday life, making it perfect for both beginners and those looking to demystify the world of investing. It's for anyone who is curious about building wealth without feeling overwhelmed by complex financial jargon. Peter Lynch is one of the most legendary investors in history, known for managing the Fidelity Magellan Fund from 1977 to 1990, where he achieved astonishing annual returns of nearly 30%. His investment philosophy emphasizes finding hidden gems in the market that are often overlooked by professionals. John Rothschild, on the other hand, is an excellent financial writer who knows how to make complex financial topics accessible and engaging. He collaborated with Lynch to translate his investment strategies and wisdom into a conversational and easy-to-read style, making the book a favorite among both newbies and experienced investors. Together, they create a perfect balance of expertise and approachability. One Up on Wall Street is built in a way that is easy to follow and understand. It's divided into short, digestible chapters, each focusing on a different aspect of investing, with practical advice and real-life examples. The first part of the book covers the basics, explaining Peter Lynch's investment philosophy and his belief that regular people can beat professional investors by using common sense. He goes into detail about how to spot potential winners in the stock market, like looking for companies you are already familiar with in your daily life. The second part of the book gets more into specifics, like how to analyze companies, what makes a good investment, and how to recognize when a stock is a good deal. The book is taking you step by step through the thought process of Peter Lynch on picking stocks and making money. Let's break down some of the key takeaways from the book and learn how to apply them to your own investing journey. 1. Invest in what you know. This is Lynch's golden rule. He believes that average people can pick better stocks than Wall Street pros by simply paying attention to the world around them. The stuff you use, buy, or hear people talk about in everyday life is a great starting point. Think about it. You already know what products or services people are excited about. That's your advantage. If you love a new product, whether it's a high-tech gadget or new restaurant in town, don't just think of it as a consumer experience. Consider it as an investment opportunity. For example, Lynch spotted The Limited, a clothing retailer, when he saw how packed their stores were. That's the kind of thing he recommends looking for. Things that people are already flocking to. Lynch himself invested in Ford after noticing how many people, especially younger drivers, were buying a particular model. He didn't need to be a car expert to see that the product was popular, and he used this observation to inform his investment decision. So pay attention to the things that excite you and people around you. If you find a product or service that you love and notice it is gaining popularity, look into the company behind it. It could be a great investment. 2. Do your own homework. Lynch stresses that the key to smart investing is research. It's not about getting tips from your friend who heard something or following the latest hot stock recommendation. It's about digging deep into the company, its management, and its growth potential. Before putting your money into a stock, understand the company. Lynch would often spend hours reading annual reports, looking into company fundamentals, and even visiting their stores. The more you know, the better your chances of picking winners. Take The Gap, for example. Lynch did his homework on the company and its competitors before deciding to invest. He saw that while many retail companies were struggling, The Gap was booming and had the potential to continue growing. His research paid off when the stock price soared. So before buying into a stock, do your research, look at the company's finances, its earning history, and its plans for the future. Don't be afraid to go beyond the basics and understand what makes the business tick. 3. Hold on to your winners. Patience is key. Lynch says that many investors sell their stocks too soon, driven by short-term market fluctuations or fears that the stock won't perform as expected right away. Great companies can take time to grow. And if you've done your research, you shouldn't rush to sell at the first sign of a dip. When you find a solid company, hold onto it for the long haul. Lynch warns against the urge to constantly buy and sell based on the market hype. Successful investing is about being patient and giving companies time to realize their full potential. He shares how he stuck with Fannie Mae even when its stock dipped and many investors panicked. The company recovered and his patience led to huge returns. His philosophy is, if the company is still strong and growing, there is no reason to sell. Once you've picked a stock with strong potential, just be patient. Resist the urge to sell at the first sign of a downturn. If the company is still performing well, give it time to grow and reward you. 4. Look for 10 baggers. A 10 bagger is a stock that increases by 10 times its original value. Lynch's goal was always to find these high growth opportunities, and he shows readers how to spot them. 10 baggers are rare, but they can significantly boost your portfolio once you find one. To find a 10 bagger, look for companies in the early stages of growth. These businesses may not be widely recognized yet, but they have something special, like a new product or service that gives them the potential for huge growth. Lynch talks about Genzyme, a biotech company he discovered early on. It wasn't a household name at the time, but Lynch saw its growth potential and invested. Over time, the stock price skyrocketed, turning his initial investment into a 10-bagger. So look for emerging companies or industries with big growth potential. Pay attention to trends, new technologies, or shifts in consumer behavior. If you find a company with a winning product or service, it could be your next 10-bagger. 5. Know what type of stock you're buying. Lynch categorizes stocks into 6 different types: slow growers, stalwarts, fast growers, cyclical stocks, turnarounds, and asset plays. Each type has its own characteristics, and understanding which category a stock belongs to helps set realistic expectations. Let's talk about each one of them. Slow growers, large established companies with steady but slow growth. Stalwarts, big reliable companies with consistent earnings. Fast growers, high growth companies with strong expansion potential. Cyclicals, stocks that move with the economy, like car manufacturers. Turnarounds, struggling companies that are in the process of improving. Asset plays, stocks of companies with valuable assets but low market valuations. Once you understand what type of stock you are buying, you can set expectations for how it should perform. For example, slow growers might not offer huge gains, but they're more stable and often pay dividends. Lynch talks about investing in Ford and other cyclical stocks. He knew that the company's performance would be tied to the economy and adjusted his strategy accordingly. So before buying a stock, figure out which category it fits into. Understand what kind of growth you can expect and adjust your expectations and strategy based on the type of stock. 6. Don't overpay for stocks. Price matters. Even if a company is great, you shouldn't buy a stock if it's overvalued. Lynch warns against getting swept up in the hype of a stock popularity and paying more than it's worth. Use financial metrics like the price-to-earnings ratio to evaluate a stock's valuation. If a stock is trading at a much higher price than its earnings justify, it may be overpriced. Lynch also talks about his investment in Lilly Pharmaceuticals at a reasonable price based on its earning growth and market potential. He avoided buying when the stock was too expensive, which saved him from unnecessary risk. Always check a stock's valuation before buying. Use the PE ratio to ensure you are not overpaying for a stock, and wait for a better price if it seems too high. 7. Understand the risks and have a strategy. Investing is risky, but understanding the risks and having a strategy can help you make better decisions. Lynch encourages diversification and long-term thinking to minimize risk. Don't put all your eggs in one basket. Spread your investments across different sectors to reduce risk. And keep in mind that investing is a marathon, not a sprint. Short-term market fluctuations should not derail your long-term strategy. Lynch himself avoided putting too much money into one sector, like tech, even though it was booming. He diversified his portfolio to reduce risk and ensure he wasn't overly exposed to any one market trend. So diversify your investment to spread out risk, have a clear strategy for long term, and stay focused on your goals despite short-term market noise. Oh, and don't forget to subscribe, because I'm here to support your financial journey. What is the first step you're going to take towards your goal today?